Hey guys, okay, so where do you put your stop loss? Where do you put it so that it doesn't get tagged on noise and so that it does take you out when you are wrong? Now, one thing to note here, guys, is that if we are scalping, we probably aren't going to use traditional stop losses per se. So the idea is that you're going to say, okay, I'm going to scalp long and I'm going to come out very, very quickly if it's not going my way, like literally 6 ticks, 3 ticks maybe. I might be a bit tight depending on what the instrument is, but that kind of thing. Maybe 10 if you're really kind of got a decent range on it, but because you're only targeting maybe 10, then 10 ticks might be a 10 to 10, 1-to-1 risk reward ratio. You might be going 6 ticks and 10, that kind of stuff. So, having a 30 tick stop on a scalp just isn't going to happen. It doesn't make any sense. You're into a day trading territory there because you're looking for the bigger trend move on the day. So you really want to be trading in and out around a key position. However, I find that it makes a lot of good sense to have a stop loss in place that basically is either an emergency stop loss that takes you out, or it's something in place that says, okay, I'm going to stop trading that from the long side now. So if you're trading from the long side using 6 tick stops and then it comes back and does something different than you expect, then you're saying, okay, well that scalping sequence, if you like, is no longer valid, because you might trade 3 or 4 times around a key level, scalp it out for kind of 10 ticks, comes back, scalp it out for 10 ticks and kind of bank 30 odd ticks, maybe lose 5 in there or whatever. But the point is, you're scalping around the level, then it does something else, but you don't want to continue doing it. So there's 2 ways of looking at this, guys. One is, okay, this is going to be your wider base stop on a kind of broader trade, or it's going to be a stop as a theoretical stop, as in this is where I will stop trading that idea, that long idea, for example. So let's look at it and see if we can kind of put it all together. So the first one is candle length. So whilst your stop may well be, if you're scalping, like, okay, if it breaks that low, I'm out, or if it comes back 6 ticks, I'm out, if it doesn't explode quickly, I'm out. Candle length is a really simple way of saying, okay, what's the biggest 1 minute candle we've had in the last hour? Oh, right, it's 12 ticks. So that's your worst case scenario stop. So you look at that, you say it's 12 ticks, it's my biggest 1 minute candle in the last hour. If the market goes against me 12 ticks, I can be pretty sure that I'm wrong from a scalping perspective. So that's a good place to put a finite stop, or like I say, a theoretical stop of stop trading from the long side now because it's pulled back 12 ticks from the level you thought it was long. You need to reassess. The second one is an indicator signal. Pretty simple this, guys. If we go into overbought territory or if we're going to oversold territory, you don't want to be trading it short. Right, you don't want to be trading it, sorry, you don't want to be trading it long. So if it's going into oversold territory and you're trying to trade it long, then maybe it's a long from a fresh setup. So in other words, we've talked about how stochastics can be useful from an overbought and oversold condition, getting a fresh long. But if you're long and it then goes oversold, you need to say, okay, well, I need to wait now until it turns back into neutral before I consider going long again. So that might be something that you use. And let's not get those too confused. It's important to notice the difference between the two, going into oversold territory and coming back out of oversold territory for a long condition. Another one might be coming back and tagging a moving average. That could be something that's your stop loss to say, well, if it tags this moving average, I'm out. And actually, it's a little kind of hint here is that if you are in a scalp trade, if you do fancy kind of stretching the legs of the trade a little bit, then often dragging a stop along a really quick moving average is a way of getting onto those explosive moves. And sometimes, because you're scalping and looking, let's say you're looking for 8 ticks or whatever, if it suddenly just rips off the upside and you're trailing that with it, you can kind of really have a massive multiple on your risk just by getting on the end of something. So that's a different kind of strategy and something that you can consider from a commercial aspect, commercial decision for you to make for your trading. All right, next one is the fixed ticks or pips. This was a favorite for me when the market is in a kind of a fixed condition, if you like. So when it's kind of sitting there and the range is relatively similar throughout the week, the month, then a fixed ticks or fixed pips, it makes sense because the range isn't kind of massively expanding or contracting. So you can say, okay, well, I can use a 10 pip stop because I know that is about right. If my timing's good, which it should be as you're scalping anyway, if my timing is good, then a 10 tick stop wherever I enter should kind of keep me within the right realms. And that's the size of of that stop is going to relate to the range of the market you're trading, the volatility as well, and the kind of market conditions. You might have some scenarios where you expand that a bit during aggressive days, and you might have scenarios where you narrow that a little bit. 10 ticks might be way too much if it's in a very narrow range. So a fixed ticks or fixed number of pips stop is an easy, clean way of reducing any decision-making process for you. So it's not a bad thing to use actually for your scalping stop. So you go, okay, right, wherever I go long, I'm always going to have a 10 tick stop, or wherever I go short, I'm always going to have a 10 tick stop. So what that can do for you is that can allow you to look at the chart and you go, right, I've got a 10 tick stop on this. So if I take it now, where does that put the stop? Oh, it puts it just above that low. Really, I want it just below that. So I'm going to wait, and I'm going to wait until the market comes to me a little bit more before I take it. So it frames things better when you've got that kind of restriction of, well, 10 ticks is going to be out. Is that in the noise? Yes, it is. Well, I don't really want to be taking it. The fourth thing is the obvious one of under support and resistance. Not a huge fan of this, guys. I prefer, for scalping anyway, it's different for swing trading, but for scalping anyway, I generally prefer to be trading against the stop. So when everyone's got their stops under that support and they've got their sell stops there, I prefer to be buying into those as a scalper. And if I'm wrong, I'll take it out even lower, because that tends to work better, because markets will probe highs, they will probe lows. So be a little bit careful about that one, but I thought I'd put it on there, anyway, for clarity and kind of completeness. Number 5, short-term high or low break. There is a point when the high breaks, and whilst we can fade it all we want, when a high is broken and it's broken it cleanly, I don't know, it's very difficult sometimes to qualify that, should I say. At some point, you've got to say, no, enough's enough. We're shorting this and now it's ripping to new highs. We're wrong. We're on the wrong side of it. We've made an error in our hypothesis, and we need to reassess and adjust, or wait until the conditions are kind of aligned for our short. So a short-term high or low break is a key point to have the stop loss. Final one, which is a really useful one, especially for scalpers, is a time-based stop. So especially in scalping, guys, you're trading for a quick reversal back. It's spiked up over a key level, bang, you're hitting it short, it's reversing, you're looking to take it out, 10 ticks, 12 ticks, 6 ticks, whatever it may be. If it starts sitting there and doing nothing, you must have a time-based stop that says, you know what, this has gone on now for 5 minutes, 6 minutes, 7 minutes, whatever that time stop may be, I need to cut it. And this, I think, is very, very important, guys. This, if I implemented this sooner than I have, this would have saved me a lot of money. The amount of times I've been in trades where I've stuck with it and thought, well, I'm going to stick with it no matter what. And it's sat there, but the conditions have just changed while you're in it. Now, this is a different thing compared to, say, day trading or swing trading, because day trading or swing trading, you're not trading based on the theory of it bursting quickly like you are with scalping. You're trading based on the theory that it's going to go from this point to that point, and the time is really irrelevant. It might sit there and then suddenly go. So it's a little bit different, but for scalping, if it doesn't happen pretty quickly, you're wrong, because the whole point of scalping is that you're trying to get those extreme stretches, those little short-term pushes to one side that you fade. It's not really a short-term push to one side, is it, if it sticks there? So a time-based stop is crucial. I really do recommend putting that as part of your trading plan if you are scalping. Whether you're scalping currencies, commodities, or indices, it doesn't really matter. Having that time-based is crucial. And guys, those 6 stop loss ideas for scalping.